Hello, good morning. Am I audible, Miss?
Yes, we can hear you and
Okay,
we can see your
so
screen.
we'll start na, Miss. So good morning, everyone. We are the first group, and our topic is about market approach. So it is one of the three valuation methods used to estimate the value of the entity. So as a reminder, the three valuation approaches are market approach, income approach, and asset-based approach. And again, we are going to focus on market approach. Next slide, please. Next slide. Okay, so what exactly is market approach? So in Philippine valuation standards, market approach compares the subject to similar business. So for instance, if you want to value Petron, you compare it to other gasoline station like Shell or Total, not Petron to kind of Forever 21, which both are significantly different. So next, business. Can you zoom in, Pao? So uh So next, business ownership interests and securities that have been sold in the market, or those that have been sold recently, or those that are still available. So another example, if you want to determine the value of stock of Jollibee, you should perhaps look at the recent selling price of shares of stock that are similar. So since ang ownership shares sa company are usually and identical, the recent selling price of the shares will perhaps provide a good estimation of the fair value. Next.
Dili
Okay, so next,
mag-next.
dili pa pa, okay. The kuan is just right there.
Guys, if the group members have their own copy of the PowerPoint presentation, then you can be the one to present lang the screen para dili ka magsigingon nga next slide. If you have a copy.
Uh, pero dili siya ma-hustle miss kay wasig madugay or something.
Kay as what I have observing when siya next niya, usahay badugay ang pag next sa slide. But if you prefer,
Uh,
sige, okay ra mo. Okay
yeah,
ra
kay some of us cannot ay malag man gud amo ang kuan net
Dili
miss if
kadaog
mag
inyong internet?
oo, yeah.
Okay, sige. Nya, I'll request na lang Paula to kuan kining full screen ang slide inday.
Okay, so next we have the three most common sources of data used in the market approach, which are the public stock market, in which ownership interests of similar businesses are traded. So that, for example, the Philippine Stock Exchange or the PSE. The second, the acquisition market, in which the entire businesses are bought and sold, and prior transactions in the ownership of the subject business. So next standard, I mean next, point.
Okay, okay. And for the next standard, it says that there must be a reasonable basis for comparison with and reliance upon the similar business in the market approach. So under this standard, comparative analysis is the key process in the market approach. It is important that comparable companies share reasonable quantitative and qualitative characteristic with the subject company, and the market prices of these comparable companies arises from arm's length transactions. Prior to carrying out the search for comparable companies, a valuer has to obtain a good understanding of the business of the subject company and the industry in which it operates. Next standard, please. Pao.
Okay, Paula, I think ang imuhang na share sa amoa is not the katong gi-present na jud nga 'Di ba there is a present button there in the PPT, katong sa
Yes,
lower
miss.
button, oo. So kato siya nga tab ang i-share dili ang katong original nga PPT nga tab.
Tesa lang, miss, kay medyo laggy ako laptop, miss. Wala gihapon, miss.
Naa na, I can see your screen but ang kato galing wala dili siya present mode. I-F5 daw.
Sinapay ga iyon na connecting.
Can you try presenting the PDF na lang, katong PDF version? I think mas kuan siya, mas okay siya. Di kayo siya
Okay,
bugat.
miss. Nga na, miss.
Yes, and then kuan daw day, Control L. Paula, can you press Control plus L sa imong keyboard?
Mana, miss.
Oh, dili lagi makit ano? So naka full screen diha sa imo ha?
Oh,
Okay. Dili man full screen
wait.
gud sa amo.
Wait, miss. Kaya na ay marag substitute.
Hello, magkita ra ang kuan?
Yes, we can see your
Ah,
screen. But naka-ano siya, percent mode.
okay. How about now?
Yes, okay na. Sige, you can proceed.
Excuse me, miss. Do we need to go back to the report or continue lang?
Continue lang, continue.
Okay, miss. Thank you.
Through analysis of the publicly traded businesses or acquisitions, the valuer often computes the valuation ratios, which are usually price divided by some measure of income or net assets. Care must be used in calculating and selecting these ratios. Next slide, please. In calculating the ratio must provide meaningful information about the value of the business. The data used in calculating the ratio must also be accurate, and also the calculation of ratios needs to be accurate. If the data are averaged, the time period considered and averaging method must be appropriate. All calculations must be done in the same way for both similar businesses and subject business. And the price data used in the ratio must be valid as of the valuation date.
So, where appropriate, adjustments may need to be made to render the similar businesses and the subject business more comparable. What this means is that in the market approach, we need to compute for a constant, which is like a benchmark to value a target company. Valuers collect observable data from financial statements of comparable companies and target company. But obviously, not all businesses are alike, so there are differences in their accounting standards, their accounting policies, and business models. So, adjustments are then made to these derived data to compensate for those businesses. Next, adjustments may need to be made for unusual, non-recurring, and non-operating items. So we also need to adjust for unusual, non-recurring, and non-operating items found in their financial statements, such as gains or losses in a company's financial statements that are infrequent and unusual that affect the data to be used by the valuers. Since these items are unique and not part of the company's ordinary day-to-day operations and maybe pang one-time ra to na transaction sa company, we need them to be adjusted to. Next, the selected ratios must be appropriate given the differences in risk and expectations of the similar business and the subject business. So basically, there are many ratios to choose from, and it all depends on the approach of the valuer. Later on, we will discuss how to select appropriate ratios to use in this method of valuation. And then several value indications may be derived since several valuation multiples may be selected and applied to the business. And lastly, appropriate adjustments for differences in the subject ownership interest and the interest in the similar businesses with regard to control or lack of control or marketability or lack of marketability must be made if applicable.
So when prior transactions in the subject business are used to provide valuation guidance, adjustments may be need to be made for the passage of time and for changed circumstances in the economy, the industry, and the business. This would mean that as time goes by, the prices would fluctuate in the process of buying and selling, which would then result to adjustments to be done in order to suit to the current market price.
So anecdotal valuation rules or
rules of thumb may be useful in the valuation of a business ownership interest, or security. However, value indications derived from the use of such rules should not be given a substantial weight unless it can be shown that buyers and sellers place significant reliance on them. So, anecdotal or rule of thumb valuation benchmarks are sometimes considered to be a market approach. So, a rule of thumb may be correct at times, but it's not accurate at all times. So in this standard, it can be considered substantial if buyer and seller place significant reliance in them. So that would be all for the standards.
Next, market approach. If we try to compare two companies that are in the same line of business and approximately the same size, we would expect them to have certain features in common and perhaps behave in the similar ways. So this is the basis for market approach to business valuation. So this approach provides indication of value of the firm by comparing it with identical or comparable business for which price information is available. So this method is called market multiple method. So with the market approach, you're comparing your company or a target company with other similar companies. So you can use comparison to similar public traded companies or to actual sales transaction or similar businesses. For example, let's say Miss Ana Paula used market approach to know the value of TikTok application. So instead of knowing its absolute value, she compares the value of TikTok to other social media platforms like Instagram, Twitter, Snapchat, and the like to determine the TikTok's financial worth. So also when comparing business, we need to be cautious. Kay it is inappropriate to compare a small privately owned business with a publicly traded company without making adjustment for the difference between them or without adjusting for size and also say tradability. Likewise, comparing the business with a business with 100,000 revenue to a multi-million dollar business is also inappropriate. So the task here is therefore to find comparable with a similar structure and operation as possible to the subject company or the one that we want to be valued. Next slide. So according to International Valuation Standard 105, the market approach should be applied under the following circumstances. So the subject asset are first, the subject asset or substantially similar assets are actively publicly traded. So delete publicly traded, but actively publicly traded. Those actively traded means that their security, which is frequently kind of bought or sold on a national recognized market. So here, the information needed to make comparable company analysis should be easily accessible, assuming that the firms are actively public traded. B, the subject asset has been sold in a transaction appropriate for consideration under the basis of the value. And C, lastly, C, there are frequent or recent observable transaction in substantially similar assets. So here, B and C will be further analyzed, especially concerning the two commonly used method under the market approach, which are the comparable companies method and comparable transaction method. Next slide. So in the first method, the comparable companies method, it looks at ratios of similar publicly traded companies, they are actively but publicly traded companies, and uses them to know or derive the value of the subject entity or the company, again, the company that we want to be valued. Next, comparable transaction method. Another commonly used method under market approach, it is a method used to value a company asset for a merger or as well as acquisition. So those who intend to acquire a company, they are usually interested in this method. So here they look out for the recent comparable transaction from valued company, which probably also have kind of same business model. So contrary to the first method, the second method, this method doesn't look at what listed companies are trading at, but it looks at what previous transactions have been conducted. So the valuer here utilize information on those previous transactions involving similar asset to the subject asset to arrive at the indication of value. So in the both market valuation methods, the key here is to look for businesses nga kanang sufficiently comparable to the subject company for the business valuation. So in both cases, the two methods use market multiple that seeks to value similar companies using the same financial metrics. Next slide. So to get the market multiple, we simply divide enterprise value to performance measures. So the idea behind market multiple analysis is that when firms are comparable, the multiples approach can be used to determine the value of one firm based on another, but based on the value of another firm. Next slide. The multiples approach seeks to capture many of the firm's operating and financial characteristics in a single number. That can be a previous slide. Okay, thank you. In a single number, I, that can be multiplied by a specific financial metric such as EBITDA, sales, cash flow to get the enterprise or equity value. So again, to get the value of the target company, we simply multiply market multiple to performance measures such as sales, EBITDA, earnings before income tax, cash flow, and many more. So this formula will be further discussed later on. Next slide.
Okay, so next we discuss the widespread use of the multiple method. But before that, what are multiples DI? So basically, a multiple is simply a ratio that is calculated by dividing the market or estimated value of an asset by a specific item on the financial statements. It is a comparable analysis method that seeks to value similar companies using the same financial metrics. So they are one of the most widespread valuation methods, and some of these common valuation multiples are equity value multiples, and then under this is the price to book value or the price to earnings, and then we have also enterprise value multiples. Under this will be the EV to EBIT and the EV to EBITDA. So as mentioned before, since the multiples are based on the values of comparable companies or comparable transactions, they are affected by market conditions. In a positive economic cycle, multiples tend to have higher values. In a recession, they are affected by price contraction. So the example in the PDF mentioned about the subprime crisis and how it affected the multiples of the luxury business in 2009. Uh, for those of you who don't know, the subprime crisis was a multinational financial crisis in the US that contributed to the Great Recession of 2007. So the EV or to EBITDA multiple of the luxury business in 2009 at the height of the subprime crisis was an average 5.4, below the multiple sectors such as the food sector and manufacturing. Then, as soon as the recovery got underway in 2012, the multiple rose to 14.6. Therefore, multiples are not independent of market volatility. Rather, they reflect volatility trends, sometimes amplifying the effect. In other words, they are dependent on the market when it experiences periods of unpredictable and sometimes sharp price movements. Next slide, please.
So, Angela, what do you think is the relationship between the multiples and the value of the firm? Is it a direct relationship or an indirect relationship?
Multiples, direct,
It has a direct relationship to the value of the firm. Why do you
yes,
say it has a direct relationship?
because it is affected. They are dependent magud on the market, miss. when it
Okay.
fluctuates.
Okay, so it has a direct relationship because if the multiple is higher, then the value of the firm is also higher. So murag same
Yes.
sila og kuan
Ah,
ba
yes,
same silang
yes.
effect. Okay, so it has a
Mm,
direct
yes.
relationship. Thank you, Angela. Okay, you may proceed.
Okay. So the reasons why the multiple method is so widely used in financial markets, we have two. First is the ease of use, and second is the objectivity. So number one, it's easy to use. It is undeniably easy to handle due to the many qualified open sources that provide reliable information on both comparable companies and comparable transactions. Before, it was difficult to obtain information on comparable transactions, but now their data are available with minimal effort or are apparently just available. The risk to this, though, is that the information provided are the main market deals only, which involves multinational companies or large size transactions. And sometimes the only element they have in common with the target companies in the industry, their size, cost structure, financial structure, and ROI, and other performance measures can be very different. Plus, open sources provide little information on the performance measures budget of the comparable companies, and in most cases, it's not sufficient to make a meaningful comparison. But it is possible to conduct a search based on several relevant parameters and to select a peer group made up of companies that have similar characteristics. The market multiple method can provide significant values only if the peer group is selected using a consistent methodology based on adequate number of parameters. Next, we have a second reason, we have objectivity. Through this method, the value of the firm can be calculated on the basis of external parameters. By themselves, they do not guarantee the best possible value, but they enable the valuer to define a range of plausible values acknowledged by the market. Next slide. Okay, so the value of the firm can also be calculated through an asset side approach and an equity approach. So for the asset side approach, the market is equal to the ratio of the EV to an unlevered performance measures. Unlevered performance measures meaning the money the business has before paying its debts or its financial obligations. So we have sales, EBITDA, EBIT, free cash flow, and then the equation for this is enterprise value over unlevered performance measures. Yes. Next, we have the equity side approach. This can be calculated directly through a levered performance measures such as price to earnings, price to book value, future cash flows, equity, and then this is the money the business has after it has met its financial obligation. So here to calculate the equity value and directly starting from the EV, net debt must be deducted. So equity value equals enterprise value minus the net debt. And to calculate the net debt, we have debt plus financial leases plus other interest-bearing liabilities plus minority interests minus cash minus liquid short-term investments. Next slide.
Okay, just a clarification with regard to net debt. Okay, so we have here debt plus financial leases plus other interest bearing liabilities plus minority interest, and this is minus cash liquid short term investment. So, usara na sila. Okay, dili na siya
Ah,
minus
okay.
cash ha. So, that is minus
Ah, yeah.
cash liquid short term investments. So, those short term investments that are very much liquid, if you remember your discussion on financial accounting with regard to cash and cash equivalents, di ba? You have specific short-term investments like money market instruments that are already considered as a cash equivalent. So dili na siya iyang nature, although technically it is a liability, but the nature of the investment, since it is a cash liquid short-term investment, then it should be regarded as a cash na. So dili siya i-appeal diri sa net debt. So that's the reason why we have to deduct that from the debt to arrive at net debt. Okay. Okay, so you may proceed, Angela.
Ah, okay. So Yes, what Miss said. Sorry for that. Um, so we have the asset side and we have a figure for the asset side and equity side approach. As I mentioned before, we have the enterprise value, and then we have the EV to revenues, EV to EBITDA, EV to EBIT, and then for the equity value, price to earnings, price to book value, and etc. Next slide.
Okay, so to clarify, we have the asset side and the equity side, right? So for the asset side, unsa ganito itong numerator, Angela?
Uh, enter, uh, enterprise value,
Okay, the
ma'am.
enterprise value is our numerator under the asset side approach. So
Yes.
therefore, enterprise value here is actually total assets. Okay, kay
Mm.
nganong gitawag man siya asset side approach nga enterprise value man di atong gigamit. So therefore we can infer that enterprise value is the representative of total assets. That's why it is the numerator. While on the equity side approach, unsa to ang numerator?
Equity value.
Okay, so kana obvious naman 'di ba? Equity value, so that is for the equity side approach. Thank you. Sige, you may proceed.
Okay, next reporter, please.
Okay, so now we go over the application of the market multiple method. So there are steps involved in the application of the market multiple method. First is the selection of peer group. Second is the choice of multiple. And third is application of multiple to the target company. Now we go over to the selection of the peer group. Valuers must make an accurate selection based on several parameters because the selection of a homogeneous peer group is essential in obtaining a reliable value of the target company. So the following are the aspects that are examined in selecting a peer group. Next slide, please. A selection of peer group in comparable companies method. Selection of peer group in the comparable transaction method and application tools in the selection of the peer group. Next slide, please. So the selection of peer group in the comparable companies method. Here in the selection of peer group in the comparable companies method, the choice of the sample requires analyzing quantitative and qualitative variables. And in this method, we have 8 parameters that must be taken into consideration. First is the industry. Second is the geographical scope. Third is competitive positioning, dimension, and fourth is dimension and performances. Fifth is part of a group. Six is maturity. Seven is time, and eight is tax rate. Next slide, please. So first, the industry. Industry classification is an important factor when choosing comparable companies. Starting with the company's industry will help an analyst find similar companies, as companies in an industry often operate similarly. Another approach to look at this is to think about what products or services that are provided by the company that is being valued. Compare these to the products and services of the companies you want to include in your universe of comparable. For example, if you were looking for comparable companies for an automotive company that produces mid-sized sedans, Toyota and Honda would both be companies in the same industry. Second is the geographical scope. Similarity in operations is a crucial factor in locating comparable businesses. In this regard, geography is also a factor to consider when deciding on a comparable universe. Consumer demographics, consumption culture, legal constraints, and product demand are all varied in different locations. A firm that exists in North America may not necessarily be successful in Asia if it does not change its product or the way it operates. Therefore, geographic region has an effect on the comparability of a firm. Next slide, please. Third is competitive positioning. Competitive positioning is a complex variable to be examined since there are no suitable metrics to quantify it. Fourth is the dimension and performances or size and performance of the target company. Um, Usually, these variables provide the basis for research strategy aimed at identifying a group of homogeneous comparable.
A comparable group should ideally be made up of companies with similar size profiles to the one you're valuing. This could be a comparison based on revenue, assets, personal count, or some other factors. Fifth is part of a group of companies. Another aspect to consider is whether the target company is a pure player or if it acts as part of a group. In general, it is preferable for the peer group of comparable companies to be formed by pure players, including when the target company is a part of a group. Next slide, please. Next is maturity. It is also important to consider maturity in the selection of peer group because, for instance, startups can have extremely volatile performances, especially in the fastest growing businesses. In such cases, the correlation between the EV and performance measure may be weak. Hence, it is important that the maturity of the target company is the same as the peer group companies. Seventh is the time frame. Valuers can choose from among different types of multiples: the current, trailing, and forward. In current multiples, these are obtained by comparing stock prices and the last available balance sheet. In trailing multiples, they are obtained by comparing stock prices and the results of the last 12 months before the date chosen to calculate the index. Results on the previous 12 months are taken by the four quarterly report or the last bi-yearly report provided by the companies. And for the forward multiples, they are obtained by comparing stock prices and the expected results of the following year or those of the next ones. Estimations are usually taken by the consensus forecast published by the Financial Analysts Association. In very volatile markets, using multiples based on historical data is preferable. And the last or the eighth aspect is the tax rate. In an equity side valuation, it is necessary to select comparables that have the same tax rate. It is advisable to compare companies that are subject to equivalent tax systems to prevent non-homogeneous comparisons. Next reporter, please.
So next is the selection of peer group in comparable transaction method. Next slide, please. So similar to comparable companies method, which is the CCM, the comparable transaction method also make use of several parameters, both quantitative and qualitative. As mentioned, this method can be based on prices that reflects premium linked to transaction-related synergies or specific competitive advantage, which cannot be extended to the target company. So in simple sense, CTM compares CCM compares similar companies, which is comparable companies method, while CTM or comparable transactions method does not necessarily compares companies, rather it compares the similarity of the transactions. So the first parameter, the firm's industry. In CCM, there is only one subject to be compared, that is the publicly traded company. While in CTM, there are three subjects. First, the target company, the seller, and then the buyer. The buyer and the seller may be in the form of holding companies, which are created, of course, to buy and possess the company shares of other company, which it then controls. And of course, the reference industry should always be that of the target company. Next, for the second parameter is the geographical scope. This is an important factor to consider, especially in cross-border transactions. The fact that different legal systems or law may be involved that could have an impact on the technicalities and pricings of the product. Third parameter is the dimensions and performance. The same factors as to comparable companies method or CCM, in terms of search method for identifying the peer group, utilizing revenues and staff count as first level criteria is recommended again. As second level parameters, the other available performance matrix can be employed, depending on analytical perspective the valuer desires to focus on. However, EV sales, EV to EBITDA, and EV to EBIT are the most common performance indicators given by databases and open sources in this method. Fourth parameter is the reference time period. The same considerations also apply to comparative companies method. So given the lack of recent important transactions, transactions over a longer period of time can be employed instead. For example, these companies under comparable transactions methods could have occurred years ago. So when the market atmosphere or condition was significantly different from what it is now compared before. So as a result, the transaction multiple would be immaterial or would be inconvenient to use in valuing the company. So unless, of course, the process, what was used before, is the same of what it is now. So next parameter is the type of transaction. So along with the payment methods or mechanism and the level of control obtained in the target company, this is another factor to consider. All of these factors have an impact on the deal's worth and as a result on the multiples. There are a variety of possibilities available, including cash payments, business mergers, buyouts, liability assumptions, etc. Next, target of transaction. So of course, this is another parameter to consider in comparable transaction method. And the last but not the least is the suspensive conditions of the contract. So this is, for instance, when a portion of price is connected to the occurrence of events that were not known at the time that the agreement was closed and could affect the overall worth of the transaction. Because we have known that suspensive condition is a condition which suspends the operation or effect of one or some of all the obligation under contract until, of course, the condition is fulfilled.
Okay,
Now,
so Vienna, can you
yes,
remind us why do we need to select our peer group again? Anong kailangan ta na ay selection of peer group?
nanong kailangan because this we are because we are looking for comparable companies by a miss. So that's why we need to select for peer group because katong there are two different methods that we can use, which is the comparable company methods and the comparable transaction method.
Okay, that is correct. So because we are trying to compare something, either the specific transaction or the company itself, we want to compare its a market. That is why we need to select our peer group. So the peer group is a list of companies that you want to compare your
Compare.
company with. And then these parameters that are being discussed by Vienna and has been discussed by Mona, Mona siya ang murag criteria ba for judging kung kani ba siya nga isa ka company is worthy ba siya i-appeal sa inyong peer group or not. Okay? Sige, you may continue.
Okay, next slide, please. Now we are down with the application tools in the selection of the peer group. Next slide. So to generate a reliable value of the target company, the market multiple technique requires the identification of the homogeneous peer group. So there are two things in particular must be taken into account by the valuer. First aspect is the number of elements comprising the peer group. Next slide, please. So a peer group size or number of enterprises or transactions cannot be determined in advance. So herewith, in general, the larger the sample size, so please remember this, the larger the sample size, the lower the standard error, which is calculated as follows. So standard error is equal to standard deviation of those comparable companies divided by a square root of n. N is the number of companies in the peer group. So for example, as seen in your copy or in your PDF, the result of the table, it shows that the multiples in the peer group A and group B in 10 comparable firms are the same. So from C1 to C10, but their standard error are different. So we conclude that we can deduce that because the group B has a lower standard error compared to group A, so it means that the group B has a larger number of companies compared to group A. And because the number of publicly traded comparable companies is statistically bigger and momentarily more homogeneous than that of comparable transactions, please take note that comparable companies method or CCM has a smaller standard error than that of comparable transaction method. So meaning that CCM has a more larger number of companies compares to CTM. Second aspect is the standard deviation of the multiples in the peer group. So yes, okay. Another factor to examine is the peer group standard deviation of multiples. In general, the lower the standard deviation, the greater the homogeneity of peer group. So as given the illustration, peer group A and peer group B, each with 6 comparable enterprises, are shown in the table. Both groups are homogeneous. The EV to EBITDA multiple is presented for peer group. Two peer groups have nearly similar mean and median values. Peer groups, on the other hand, have diverse values. When compared to peer group B, peer group A has a higher dispersion with a span of 4.9x to 12.9x, and peer group B with a range between 7.8x and 8.5x. The standard deviation, which is 2.95 for group A and 0.27 for group B. The standard deviation depicts how data in a peer group are dispersed in relation to the average. In other words, the standard deviation indicates if the average is a reliable figure, whether it gives a meaningful representation of the data. The lower the value, the more dependable the peer group, as it has a less dispersion.
So in short, Vienna, unsa man ato ang ganahan i-achieve? Higher standard deviation or lower standard deviation?
The lower. Uh, as the lower the value.
Unsa gani meaning if lower ang standard deviation, it says here the greater the homogeneity of the group. So that
Yes,
means if lower yung standard deviation, mas homogeneous sila, right? Unsa gani nang homogeneous? The same.
the same,
The
yes.
same, right? So mas parehas sila ang mga peers dinhi sa here in your table 5.3 we have 6 peers, right? So 6 peers within group A, 6 peers also within group B. However, peer group A and peer group B have different standard deviation. So if you look at table 5.3, the standard deviation of peer group B is lower than that of peer group A, right? So which peer group man imuhang pilion para i-compare nimo imuhang company with? Would you choose group A or group B? Unsa nga companies, asa man nga mga companies nimo i-compare ang imuhang company, own company sa group A or group B?
Group B, miss,
Okay, group B kay ngano man?
because it has a less dispersion, miss.
Okay, so lower iyang standard deviation, and if you go back to the first aspect, if low ang imuhang standard deviation, low pod imuhang standard of error, right? So
Yes,
lower ang risk of having an erroneous result sa imuhang sa imuhang pag-compare sa mga
for
kanang members of the peer group, correct? So unsa ato ang mas ganahan? Higher or lower standard deviation?
lower standard deviation.
Okay, lower standard deviation. Thank you. You may
Okay, thank
proceed.
you. Next reporter, please.
Okay, so since we are done with the first step in applying the market-based approach in valuation, we will now move on to the second step, which is the selection of the choice of multiple. Next slide. So once the peer group has been selected, the theoretically best multiple or multiples should be identified. Meaning if multiples ang atong gamiton pag-value sa usa ka peer group and target company, we need to use the most suitable one to arrive at an accurate valuation. Next slide. Next. So basically, there are a lot of multiples to choose from, and one way to choose a suitable multiple is through correlation. Now, correlation helps understand the relationship between the multiplier and a performance measure. This helps identify the multiple that better depicts the business with respect to a parameter that is considered significant. So the importance of this is because, as I've said before, there are many multiples to choose from. And there are those that examine profitability, like the EV to sales, and we also have those that measure solvency, like the EV to free cash flow, and a lot more. So it was also discussed that there are different approaches in the market-based method, like the asset and the equity approach. Thus, these multiples inevitably lead to different results and may lead to an inaccurate benchmark if we are going to use the wrong multiple. Next slide. So for example, looking at our table here, assuming that we have already chosen our peer group, that is C1 to C10, we will now compare two multiples from the peer group, the EV to free cash flow and the EV to sales, in order for us to know which between the two best correlates to the chosen performance measure, which is the EBITDA margin percentage. Next slide. So how do we correlate? So for convenience, I just used Excel to compute by using the Correl function for correlation. So atong i-correlate una ang EV to free cash flow to EBITDA margin percentage. So in doing that, just input the correlation function, and then ang array 1 would be the EV to free cash flow, and ang array 2 kay ang EBITDA margin percentage, and then just repeat that with the EV to sales. Then the results would be 0.90 for EV to free cash flow multiple and 0.54 for EV to sales multiple. So mas dako ang correlation sa EV to free cash flow to EBITDA margin percentage. So given these results, we can infer that the better choice is EV to free cash flow multiple to arrive at an accurate valuation. Next slide. So, but it doesn't end there. We can still solve for the coefficient of determination, which is r squared in the table, to reinforce our claim that it is best to use EV to free cash flow. So ato rang squared ang correlation. So for EV to free cash flow, the result would be 0.81 and 0.29 for EV to sales. So still same results, and as stated before, in general, the lower the standard deviation, the greater the homogeneity of the group. But in this table, even though greater ang standard deviation sa EV to free cash flow than the EV to sales, we can still claim that EV to free cash flow still has a closer relationship with EBITDA margin percentage than EV to sales, because mas dako ang iyang correlation and coefficient of determination, meaning mas strong iyang relationship between the two variables. Therefore, in this perspective, EV to free cash flow more reliably reflects the value of the target company, and that is how we correlate multiples and the performance measure. Next, reporter.
So, Paula, so
Yes,
what is
miss.
the rule then with regard to correlation? What is the rule? So, for standard deviation and standards of error, the lower the better. But for
Yes.
correlation,
The higher, the better, miss.
okay, thank you.
Thank you.
So for asset side approach, the market multiple is equal to EV divided by an unlevered performance measure. And the most commonly used performance measures are sales, earnings before interest, tax, depreciation and amortization, earnings before interest and tax, and free cash flow. Next slide, please. Let's discuss first about EV sales. So, EV sales multiple measures the value of a business based on sales. It is calculated by dividing enterprise value with sales. Sales-based multiple has a good correlation with the multiples of companies in the peer group. This is due to the fact that sales are a first-level parameter when selecting a peer group. Business valuation based exclusively on EV sales might not be advisable since revenues do not provide sufficient feedback on the firm's efficiency, attitude to generate cash flows, and ability to meet obligations. Example, Company A has an EV of $1,020,000 and earned $850,000 in sales. To compute for the EV sales multiple, we simply divide 1,020,000 and 850,000 to get an answer of 1.2. Next slide, please. EV sales may only be used as a standalone parameter if the target company and the peer group have numerous elements in common, such as EBITDA margin, debt to equity, and so on. The sales multiple is typically used as a shortcut to quickly evaluate technology and high-growth companies with negative profits and cash flows for which reversing the trend in the short term is unlikely. In these companies, sales are a more stable performance measure than profit or cash flow. EV sales does not independently provide a feedback on value, as it is not able to grasp the complexity of a company. Ultimately, EV sales is rarely used as a single multiple and is more frequently used as a control multiple. Next slide, please. EV/EBITDA multiple measures the value of a business based on EBITDA. It is calculated by dividing EV with EBITDA. This multiple is widely used since it is not significantly influenced by accounting policies. It is relatively neutral multiple through which firms in the same industry can easily compare. There is a limitation in applying the EV/EBITDA multiple since investments are not taken into account, which may lead to an over or undervaluation depending on the amount of depreciation or amortization. Example,
So,
Company A.
excuse me, Nicola. So, why do we
Yes, ma'am.
say that EV over EBITDA does not take into account investments? Nganong wala man daw na take into account if EBITDA ato ang gigamit? Why do you think so?
Because, miss, depreciation and amortization is not taken into account, miss.
Mhm. So, nga naman di ay, unsa man di naa ng depreciation or amortization?
In depreciation, it usually involves uh,
So,
investments in fixed assets, miss.
correct. And how about amortization?
And amortization in miss,
Investments in what?
investments in financial assets
And
or
intangible assets,
that.
right?
Okay, yes, miss.
Correct. So since we are excluding kay before depreciation and amortization, so we do not take into account the investments. That's why mo na iyang gibutang dira as a limitation. Sige, thank you, Nicholas. Proceed.
So, example, Company A has an EV of $918,000 and an EBITDA of $170. To get the multiple, we divide 918 with $170 to get the answer of 5.4. Next slide, please. Next is the EV/EBIT multiple, which measures the value of a business based on EBIT. We can calculate the multiple by dividing EV with EBIT. Then this multiple provides a more complete information than EV/EBITDA since it takes into account the firm's investment, evaluates the business based on operating profit, and also considers the effect of amortization and depreciation. Although its limitation would be it is more exposed to the influence of accounting standards, investment policies, and business model. Example, Company A has an EV of $492,000 and an EBIT of $60,000. To get the multiple, we divide 492,000 with 60,000 to get 8.2. And don't mind the competition shown in the presentation kay nasayop na siya. Pero sakto ang answer. Next slide, please. Ultimately, EV/EBIT has the advantage of measuring value based on operating profit. In general, companies that require a high level of investment have EV/EBIT multiples significantly different from the EV/EBITDA multiples, while company with low level of investments, the EV/EBIT and the EV/EBITDA tend to coincide. Next slide. Shown in the table are the EV/EBIT and EV/EBITDA multiples of companies in the automotive industry. Just by simply comparing both multiples, you can immediately conclude which company has high or low level of investments. Investment-intensive companies include Toyota, Daimler, Ford, Volkswagen, BMW, Nissan, and General Motors Company. Next slide, please. Next is the EV FCF or free cash flow, which
Wait,
calculate
wait sa ha. Balik sa daw previous slide
uh,
first. So, how did you arrive at the conclusion, Nicholas, nga previous slide daw? Okay. So, you mentioned that Toyota, Daimler, those companies are what again?
has investment intensive companies
Okay, investment intensive. Nganong nakaingon man ka nga by looking at our EV/EBITDA and EV/EBIT?
because as what I have said before, Miss, companies that require a high level of investments have EV/EBIT different from EV/EBITDA multiples, like lagi ora sila.
Okay, correct. So, asa man ani ang dili kaayo wala kayo nag-focus sa ilang mga investments, which of the companies here?
I think it's the Mazda, Pugo, Kia, Fiat,
Mazda. Okay, why? Because
because their EV/EBIT and EV/EBITDA are close man, ma'am.
correct. Correct. Thank you. Sige,
Okay.
proceed.
So in EV/FCF, it takes it week time, which calculates the EV taking into account the ability to generate cash flow. This is calculated by dividing EV with FCF. As a performance measure, cash flow is neutral since it is not influenced by either accounting standards or accounting policies, and it is objective because it measures value based on data that is certain. The only limitation in using free cash flow is that it is subject to a certain degree of volatility over time, since it is influenced by various elements such as trade receivable turnover, trade payables turnover, capital expenditure, and so on. Although it is a multiple based on objective data, its application is less widespread than income statement multiples. Example, Company A has an EV of $1,800,000 and a free cash flow of $500,000. We simply divide both to get 3.6. Next slide, please. The inverse of EV/FCF is the FCF yield, which is free cash flow divided by the enterprise value. It is a return evaluation ratio of a stock which indicates the FCF a company is expected to earn against its market price. It establishes the relationship between the money an investor puts in a company compared to the returns it gets. Generally, the lower the ratio, the less attractive the investment is, while the higher the ratio, the more attractive the investment. Next reporter, please.
Okay, Nicholas, why do we say that if the ratio is lower, meaning if the FCF yield is lower, why do we say nga that investment is less attractive?
Um, because economists they lower the ratio, the lower the investor kanang lower ang return ang makuha sa investor, miss.
Correct. So, mas gamay ang kwarta nga imong madawat from your investments if your FCF yield or If your ratio here is lower, that is why as an investor, that investment would be less attractive to you. Okay, so you aim for a higher ratio. Ang ratio pasabot ani is this one, the free cash flow yield. Right? Thank you, Nicholas.
Thank you, Miss.
Okay, so the last step is the application of the multiple to the target. The third step is the application of the multiple to the target company. So I'll just skip myself for this one for a while. So as you can see in the PDF that has been sent, okay, we have a sample. We have the sample company which shows the different business sectors. So as you can see, it also shows the years and how the EV EV EBIT and the beta has changed over the years. So during this time, so the EV/EBITDA and EV/EBIT multiples are different indicators. Thus, an in-depth analysis is proposed, which sets two objectives. So the first is to verify how the EBIT, EBITDA, and the EV/EBIT evolved in the 2005 to 2015 period through the comparable companies method. And the second is to identify the multiple that has the lower level of volatility. So from a methodology from so as you can see, so the multiples vary across sectors due to differences in the competitive environment, the business model, the financial structure, and so on. So on average, the beta coefficient is 1, which confirms that the peer group has a neutral risk level and any volatility in the value of multiples does not depend on high risk sectors. And third, the EV/EBIT multiple has a higher standard deviation than the EV/EBITDA multiple, presumably due to the different level of investment in the various sectors. So going back to the table, so as you can see, we have different. So I mean, this could it should be also noted that the multiples would refer to an extremely long period of time, and during that period, there are many changes that took place which would have an impact on the volatility on the markets and therefore on the values. So in this table, it shows that this is like a sample of a North American market. So each of these for this year are to be considered, which is the 2005 to 2015. The EV/EBITDA and EV/EBIT multiples and beta coefficient will be identified. So next slide. So as you can see, the as you can see, there are different business sectors to be considered, and the multiples vary within each year. It started from 2005 to 2015. The different the values of the multiples also differ within each year. So the evolution and volatility in multiples over time. So each sector's mean, medium, mean, max and standard deviation has been calculated, and the multiples would change from one year to another, sometimes significantly, and especially in sectors characterized by a higher degree of volatility. So the most significant change took place in 2008 on the upset of the subprime crisis. So as you can see, from the years 2005 to 2007, it had a it had a from from 2000, as you can see in 2008, there is a significant decrease on the EV EBITDA, and after that, it slowly increased as the years go by. So, like for example, the air transport, it from in 2005, it had an EV EBITDA of 11, and in 2006, it had an EV EBITDA of 8.5. 2007, it's 6.4. But as 2008 comes, it had an EV EBITDA of 4.8. So here are other business sectors to be considered. So this is the year-on-year percentage change and the EV EBITDA multiple.
Okay,
So
so the 2005 is your base year, right? Base
yes, ma'am.
year. Okay.
So as you can see, let's say for example, the EV EBITDA of the the power industry shows a significant interval between the minimum and maximum value. The maximum value, which is shown in 2008, is 7 times the minimum value shown in 2011, and it has an even greater volatility, which can be observed in the EV/EBIT multiple. Next slide, please. So as you can see, there is a significant cha- significant change in the EV/EBIT during the year 2008. Uh, so So to identify the multiple with the lower volatility, the standard deviation of EV EBITDA and EV EBIT is compared in this table. So it is immediately apparent that the EV EBIT multiple has a higher standard deviation than the EV EBITDA. So we can assume that the EV EBIT ratio has a higher volatility than the EV EBITDA ratio. Next reporter.
Equity side multiples. So, equity side approach, as introduced by Ms. Angela Quezeo, it is equal to the ratio of price to a levered performance measure. So, commonly used performance measures under this are the earnings growth, the book value, and the free cash flow to equity. So, first is the price to earnings. The price to earnings ratio is the ratio of the market price per share to earnings per share. So it is a valuation ratio of a company's current price per share compared to its earnings per share. So kanang showed in the screen is the formula for price to earnings. So this multiple is widespread in financial community. Why? Because it is simple to calculate because both man kanang price and earnings are easily available performance measures. So we have kanang example for price to earnings. Company A shares are trading at $50 per share, and the recent earnings per share is $2 per share. So PE multiple is then computed as price divided by the earnings per share, which is $50 divided by $2 equals 25. So we have kanang price to earnings multiple of 25. This shows how much the market is willing to pay for $1 of expected earnings. Next slide, please.
Okay, but take note ha nga in writing multiples, you need to include the x. Katong x gani nga
Yes,
kuan. Butangin yung x para it would indicate nga this answer is
na
a
ratio.
multiple. Multiple, okay?
Yes,
Okay, ang time x is times man because multiple is times, di ba? So 25
Hmm.
times dapat na ay x. Okay. Sige.
Next slide, please. Thank you. So the PEG ratio. The PEG ratio measures the relationship between the price to earnings ratio and the earnings growth. So the PEG ratio allows investors to calculate whether a stock's price is overvalued or undervalued by kanang analyzing the recent earnings and the expected growth rate for the company in the future. So kanang ang PEG ratio considered siya undervalued if less than 1 siya, and kanang overvalued if greater if ang PEG ratio is greater than 1. So it is calculated by dividing the price to earnings by the expected growth rate. So kaning uh, uh next next slide. Yes. Kaning example, so in the example sa given na ay kanang naa na tay price to earnings ratio diri for company A kanang it's 7.5 and 10 for company B. So assuming that the expected growth rate of company A is 5% and company B is 15%. So by applying sa atong formula, the PEG ratio for company A is 1.50 x sa last, and for company B it's 0.67. Nakalimut ko butang x. So
Okay, so again, so if the PEG ratio is less than 1, okay, what does it mean?
less than 1 means if less than 1 if undervalued, and
So
overvalued if
here,
greater than 1.
if
At
the company B is what? Undervalued, overvalued.
undervalued means
While company A is
overvalued.
because
Company A has PEG ratio kanang greater than 1. So it means na company is overvalued. Kay ang investor, it means that an investor kay is asked to pay kanang more than proportional price compared to kanang future
mhm,
future earnings growth. While kanang company B siya undervalued siya, less than PEG ratio is kanang less than 1. It means na ang investor is asked to pay convenient price compared sa kanang future earnings growth.
okay. So how about
So,
if the
uh,
PEG ratio is exactly 1? What does it mean? Kaya nga man ta, if more than 1, that means it is overvalued, while if lower than 1, it is undervalued. What if exactly 1?
kanang kuan miss kanang perfect correlation.
Correct. Correct. It is correctly valued, right? Correctly valued. There is no under or overvaluation. Like correct lang jud siya. Now, if you are a potential investor, no ganahan ka nga mo invest ka isa ka company, unsa man imong ganahan nga company aning duha, A or B?
Mm,
So if you have
um
limited amount of cash and then you just want to invest it in one single company and then you were able to compute for the PEG ratio of both companies, company A and B, which company would you prefer nga mo investan nimo?
ang company B tingnan mo.
Tingali so
Company
nganong
B?
nganong B man?
Oh wait.
Okay, so that is correct.
Ang
Company B, no?
undervalued.
Undervalued kay
Yes,
ngano mura
company
kag
B appeal.
naka-discount ana. So mas ganahan kang palit ana because mas daghan imong makuha sa imong actually nga gibayad because the company is undervalued, barato ra siya compared sa what it actually is. So you want to invest in a company that has a lower PEG ratio. Sige, let's proceed.
Next slide, please. Thank you. So, kanang price to book value ratio is an investment valuation ratio used by investors or finance providers to compare market value of a company's shares to its kana book value. So, this measures the value of a business based on the book value of equity per share. So price divided by the book value of equity per share kaning naa sa screen man siya ang formula. So also price to book value ratio is kanang greater greater than one suggests that the stock price is trading at a premium to the company's book value. For example, if a company has a price to book value of 3, so it means that its stock is trading at 3 times its book value. So as a result of that, the stock price could be overvalued relative to its asset. On the other hand, uh, price to book value ratio kanang with lower values kanang particularly kanang those below one could could be a signal to investors that a stock may be undervalued. So in other words, the stock price is trading at a lower price relative to the value of the company's asset. So kani siya na multiple kaning price to book value is best suited siya to banks and insurance companies. Why? Because they have kanang large numbers of financial assets. So price to book value sad kay has its limitation. Like if ang company mag-use og kanang different accounting standards like local accounting standards and kanang IFRS, so it gives different values which makes the kanang comparison gani even harder. So kanang applying different accounting standards cannot be valued using price to book value multiple.
Okay, so
Next,
Anjali, which one, as a
yes.
potential investor, which one do you want to see? Do you prefer a higher ratio or a lower price to book value ratio? Which one is
But
attractive to you as an investor?
uh, I I I think ma'am kay kanang kuan um the the kanang greater than one ma'am.
Greater than one? So you want to invest in
Ah, kan,
overvalued stocks?
I think ma'am kay kanang more considered siya as a positive indication ma'am ba? if
Ay,
if higher
okay, so kani siya
sa
ha. So if you
value.
are a potential investor, meaning when we say potential investor, dili pa ka investor, you are still planning to buy. So if you want to buy a specific stock, ganahan ka mahimong investor nila, you wanna look for a lower price to book value ratio. However, if you are an existing investor and you want to sell your stocks, no, imong is-sell, then you want to achieve a higher price to book value ratio. So if you are buying, dapat ganahan ka og lower ratio kay para mas daghan imong mapalit kay undervalued man siya. But if you are planning to sell your stocks, ganahan ka og higher price to book value ratio kay medyo na may premium so mas dako ka og income if you sell it. Okay?
Yes, ma'am.
Okay, sige, continue.
Um, kanang next slide, please. Price to free cash flow to equity. So kanang this multiple compares price with its ability to generate cash flow. So formula niya is price divided by the free cash flow to equity. So as a performance measure, um, cash flow is neutral and objective. It is neutral since kanang it is not influenced by either kanang accounting standards or kanang accounting policies. Then objective siya because kanang it measures value based on kanang data that are kanang certain ra. That that would be all, miss.
Okay, sige. So again, let's summarize. Let me call on Angela Caseo. So what are the two methods under market-based approach, Angela? Angela, you are muted. How about Nicholas? Okay, to summarize, what are the two methods under market-based approach?
Um, uh, Comparable companies method and comparable transactions method, Miss.
Correct. Sige, thank you. So we have comparable companies and comparable transactions. So I think the name itself suggests know what are the differences between these two methods. So if you are to compare the company as a whole with another company or companies within the same industry, katong tanan parameters nga gi-discuss ganina sa inyong classmates, no? Um, you want to compare the entirety of the company, so you can use the comparable companies method. However, if you are looking at a specific transaction lang, you can use the comparable transactions method, particularly katong mergers and acquisitions nga transaction, so you can use comparable transactions method. And then your classmates also discussed the sides of the equation, so we have the asset side and the equity side. Now in general, the asset side approach gives us the formula, enterprise value over a specific performance measure. So mo na siya ang general nga formula under asset side approach. Again, enterprise value as the numerator, and then for the denominator we have the performance measures. So if you are to apply the specific performance measures, you have to change the denominator, but the numerator is the same. So again, from our generic nga formula nga enterprise value over performance measure, the enterprise value is a constant, no? Ang denominator nga performance measure will change depending on the multiple nga imong ganahan gamiton, 'di ba? So, for example, for the asset side approach, you can use performance measure nga sales. So that would be enterprise value over sales. You can also use the performance measure nga EBIT. So your denominator will be EBIT. You can also use EBITDA, right? You can also use free cash flows. So what will change is your denominator depending on the performance measure that you want to use. Okay, so kung unsa man gani nga performance measure imong ganahan i-use, unsa ganito ato ang gamiton nga kanang criteria to choose which performance measure and which multiple ato ang gamiton. You can look at the standards of error or your standard deviation, right? So if mas gamay ang standard deviation for that particular multiple, then mao imong gamiton. For example, if mas gamay ang standard deviation sa multiple with respect to EBIT as compared to EBITDA, if mas gamay ang standard deviation, then you have to use EBIT. Kay mas nindot siya nga multiple. Okay? So again, for asset side, the numerator is which is your enterprise value. What will change is your denominator. Again, ma-change imong denominator because magdepende man sa imuha kung unsay imong ganahan nga performance measure. So whatever it is that you decide nga ganahan ka nga performance measure, be it sales or EBITDA or whatever, that will be your denominator. Now for the equity side, the generic formula for this is, ano sige ito, Anjali, Doriquez? What is the numerator?
Price,
No, for the
ma'am.
generic
Oh,
formula. We have the equity
generic
value,
one.
right? Equity value.
Oh,
And then over
the equity value.
equity value of the levered performance measure, right?
Oh, yes. Oh,
Correct.
yes,
So
ma'am. Level
that is
performance measure.
okay. So okay, sige, thank you, Anjali. So for the equity side, your numerator will be equity value and then over the levered performance measure. So still we have performance measures here, but this time those levered na nga performance measure. So unsa pasabot nga levered, taking into account your debts, mga utang. Okay, so if you apply it to a specific multiples under the equity side approach, kato imong numerator nga equity value, that is actually the price. Okay, so the numerator nga equity value mao na siya si price. Price sa unsa man sa imong product dili. Price sa imong equity or stocks. So that's why as numerator we will use the price under the equity side approach. Now, ang denominator mao pud na ang ma-change, no, depende sa imong ganahan nga performance measure nga levered. So, as discussed by your classmates, we have your earnings per share, we have the book value, we have the growth, right? And then free cash flows to equity. So, ang inyong denominator ang ma-change depende sa unsa imong ganahan nga performance measure. Okay, so by dividing the numerator divided by denominator, you will arrive at your desired multiple. Okay, and then in writing multiples, don't forget to include x. Okay, ang x dira, pasabot na times. Okay, multiple man siya. So for example, 1.5. 1.5x, you will read it as 1.5 times. Okay? Sige, so any questions from the class? Wala?
Nakoy question, ma'am.
Oh, okay, Danielle.
So what if the denominator is negative, ma'am? Let's say for instance, in the equity side, if you calculate kintahay the PNA using PNE. So
Price
for instance,
earnings per share?
yes, ma'am. For instance,
Okay.
example, Huawei decided to buy or wants to buy Dito. We all know that Dito is just starting, so may
Mhm.
negative yun na yung PNE. So do we still use the PNE ratio as a performance measure or okay
Okay,
lang na
so
negative?
in that case, dili man siya kay, di ba, we are looking at comparables, right? Here, under market-based approach, we are looking at comparables, either comparable companies or comparable transactions. Now, since dito is still a startup business, no, kung makonsider magyapon nato sila as kung sa ilahang life cycle na pa sila sa birth nga phase. So, if you just use price to earnings per share nga ratio, that would result to an erroneous analysis on your part. So you might want to use other multiples that would best describe the performance of dito.
Thank you, ma'am.
Okay. Sige. Any other questions? Okay, so hearing none, I hope nga na-grasp ninyo ang basic understanding of our market-based approach. Take note that for market-based approach, ano gitawag siyang market because you look at other players sa market. You look at other companies in the market. You look at other transactions sa market that are similar to your own transaction in order for you to get the value of the firm. And then we have learned the different methods and the different approaches with respect to the market-based approach. We have the asset side approach and the equity side approach, and then all the multiples under those approaches. Okay, so thank you so much to all the reporters. You did a great job, and I really like your presentation, and I also like your way of discussing things. So expect a good grade. Thank you so much. And then since we still have time left, I uploaded a short quiz, a very short quiz only for questions in Canvas. So please make sure to um, visit Canvas after this call. You have until 12 noon to answer it. Okay, very short questions, 4 questions lang. You have a 10-minute time limit for you to answer all 4 questions. Okay, so let me just check your attendance lang sa ha. I see 23 people here absent. Usara ang absent. For a while. Kinsa nyo nabantayan nga absent? Alhibe here.
Present, Miss.
Irish Baldonado.
Present, Miss.
Daniel is here. Micah. Micah. Micah was here a while ago, right? But she keeps on disconnecting.
Na
And
siya ganiha,
then,
ma'am.
okay. So si Micah ra ang wala diri sa kuan. All right. So everyone is here. Thank you. And then please check your canvas. We'll talk to you again tomorrow. And then the next reporters will be those that are to report the income-based approach. All right. Thank you and good morning.
Thank you,
Thank you,
Miss.
ma'am.
Thank you, Miss.
Thank you, Miss.
Thank you, ma'am.